Thanks for joining us. You've tuned into Arirang's Within the Frame. I'm Han Da-eun in Seoul. A wave of important economic headlines rolled in this week as we kick off the second half of this year. The South Korean government unveiled key economic policy measures for the latter half, prioritizing price stabilization and reducing the cost of living for ordinary citizens, while the U.S. Federal Reserve released key clues as to where inflation is headed and when interest rate cuts may begin. That's as South Korea implemented major changes in the foreign exchange market to attract more foreign capital and enhance the competitiveness of the local currency. For expert analysis on these developments and the market outlook for the next 6 months of 2024, we turn to Kim Sei-wan, a professor of economics at Ewha Womans University. It's always great to see you.
Thank you for having me today.
Also with us tonight is Trin Nguyen, senior economist at Natixis. Welcome to the program.
Thank you for having me today.
All right, Trin, let's start off with you. The FOMC minutes were unveiled on Wednesday, while Fed Chair Jerome Powell made some important remarks during his closely watched speech at a central banking forum in Portugal. What are the key takeaways from them?
The key takeaway is that we have inflation slowing, which is a great sign, but we're still nowhere near the 2% target. So we will need more consistent data to show that inflation is moving closer to the 2% target. Obviously, the Fed doesn't even think that, based on the SEP, that it will reach this target until end of 2026. We think they'll get there around end of 2025. And I think most importantly, we'll also need to see significant softening of the labor market. The strength of the labor market is a concern, meaning that we need demand to also soften to make sure that inflation is decelerating and that monetary conditions, which real rates are very tight, are tight enough to cool domestic demand in the U.S. In other words, things are going in the right direction, but not yet enough for a rate cut. And so we have to wait for now. And we don't have conditions just yet for it. And we're unlikely to get it by July.
So quite a bit of progress on inflation, but not quite there yet to start cutting rates. And we're cautiously expecting a possible rate cut in September, according to markets, and we'll be sure to keep close tabs, not only on prices, but also on job figures, as you pointed out. Meanwhile, Dr. Kim, South Korea's consumer prices remained in the 2% range for the third straight month in June. In fact, last month's 2.4% rise marked the smallest increase in 11 months. In your view, are conditions ripe for a rate cut in Korea?
Well, the inflation in Korea is stabilized at 2% level from March of this year. So thanks to this lower inflation, it is true that the possibility of Bank of Korea's interest rate cut became higher than before. But US dollars gets stronger these days with higher $1 exchange rates. It means that if Bank of Korea cuts its rate before U.S. Federal Reserve does, $1 exchange rate will be higher and more volatile, which is additional burden to domestic price level by raising import prices. So for stabilizing foreign exchange market, it would be difficult for Bank of Korea to cut base interest rate early.
So we're starting to see inflation cool, and the government also expects prices to drop further in the latter half, but we're not completely out of the woods yet, with the monsoon rain also expected to push up the prices of fresh produce. And also, as you mentioned, the $1, there's also the $1 volatility risk. And just like the U.S. Fed, it looks like the Bank of Korea still needs more conviction to start cutting rates. And staying with you, Dr. Kim, the government has announced some major changes in the foreign exchange market, which has stayed the same since the 1998 financial crisis. These include pushing back FX market closing time for $1 exchanges from 3:30 p.m. to 2 a.m. the next day. What significance does this hold, and how did it play out in the first few days?
Basically, by extending trading hours in foreign exchange market, Korean government aims to enhance the convenience for investors in currency exchange market and reduce transaction cost. Foreign exchange investors can now buy and sell foreign currencies at real-time exchange rates until 2 a.m. And foreign financial institutions that have received government approval can directly trade foreign currencies in the domestic market. This will significantly increase access to foreign exchange market. As a result, there is a growing anticipation for Korea's inclusion in the World Government Bond Index, which is WGBI, and that could attract more funds to domestic capital market. After extension of trading time, there are no abnormal signs in Korean foreign exchange market so far.
And in related question, Trin, how much would South Korea's significant extension of foreign exchange trading hours from 6.5 hours to 17 hours help in attracting more foreign capital and also in elevating the Korean won's position in global financial indexes?
Well, Korea and India, the two major countries, are not yet included, right? So its time is ripe to be included. Moreover, it's seriously considering it. It's been on the watch list since 2022 September, and it's been very, very serious about taking steps to address it so that it can be included at the upcoming September meeting. So I think the odds are quite high. I think investors have positioned for it if you look at bond flows, and it certainly will help. I think being included in the bond index is going to be much easier than the equity index, which wants to be lifted for DN. Now, I think the significance is that with the passive flows, it will free up space for Korea, given that it will be funded by foreign investors. And the second thing is that it will offset some of the outward FDI flows that Korea is doing to make sure that it's competitive. Firms such as Samsung Electronics and et cetera have deployed capital, Hyundai, autos, and so on and so forth in the US. That's led to capital outflow, right? While that means that it's going to be able to compete better than China and the US thanks to preferential, but it has led to a significant deterioration of the Korean won. And the second thing is that the current account is in surplus, but not always, right? So therefore, positive portfolio inflows is quite positive for the Korean won.
Well, the Korean government believes the extension of the trading hours is an important step in advancing Korea's FX market closer toward global standard. There are fears that it may raise FX market volatility, but hopefully it'll serve its purpose and yield some positive results. Dr. Kim, the Yoon administration has announced key economic policy measures for the latter half of 2024. And these include injecting 5.6 trillion won, or roughly $4.5 billion, to stabilize prices and help reduce the cost of living for ordinary citizens. It also plans to minimize public utility fee hikes. Walk us through the key points of the second half economic policies and also your thoughts.
As we talked about, Korean inflation is pretty much stabilized at low 2% level as of now. But general citizens do not feel this because prices of agricultural products like fruits are still rising in a larger scale. So government will allocate 5.6 trillion won to manage inflation and reduce living costs in the second half of this year. Additionally, they plan to minimize public utility fee increases in gas and electric power. Also, to support revitalization of construction investment, the scale of public investment and private sector projects will be expanded by 15 trillion won. In more details, zero tariffs will be applied to 51 agricultural products and food ingredients. And the interest rate for student loans for the second semester will be frozen at 1.7%, and the support for income contingent repayment student loans, as well as the eligibility and duration for interest exemptions, will be expanded. So basically, Yoon's government is trying to save low-income people's economic pain over the recession of the economy.
The government also raised this year's economic growth forecast to 2.6%, citing stronger than expected export recovery. But average citizens are yet to feel that the economy is getting better in real life, especially the most vulnerable groups, as you mentioned. So we can see that the policy measures are focused on reducing the financial burden on citizens and struggling small business owners as well. Now, moving on to stock markets, Professor Kim, the earnings season will kick off this week with Samsung Electronics set to announce its preliminary second quarter performance tomorrow. Would Korea's benchmark Kospi rise back up to the 2,800 level? And what's your overall outlook for local stock markets in the second half of this year?
Well, first of all, I have to say that it is very difficult, actually almost impossible, to forecast future stock prices based on economic model. So there could be lots of errors in my saying today. Domestic market is waiting for Samsung Electronics second quarter performance announcement tomorrow because it is the largest cap stock in Korean market. And market expectations for Samsung Electronics performance in the second quarter are very much optimistic. Analysts predict a significant rise in operating profit, largely driven from higher memory chip prices and increased demand for many different kinds of semiconductors that Samsung is producing. Due to this positive signal, Samsung stock price rose over 3% today. And in the second half of this year, overall, Korean corporations on average will have better performance along with slow Korean economic recovery and global economic recovery too. So I am pretty much positive on that Kospi goes up upper 2,800 level by the end of this year.
And Trin, we want to get your global stock market forecast for the next 6 months. Would the bullish trend led by big techs continue into the second half?
Right. So if you look at very similar to South Korea, we have higher rates, right? Central banks are have hiked rates, and they also try to do QT, so which is to tighten liquidity via reducing the balance sheets. But at the same time, stocks continue to grind higher, right? So what we are seeing here is that the global economy for export-oriented countries, they're benefiting from the rise of the ICT cycle, the rise of AI, and so on and so forth, and that's reflected in the U.S. Concentration performance intact. So when you look at that and even relaying it to the US, there's pockets of weakness, right? Some consumers are feeling the pain of higher rates, but larger companies are absorbing much better, right? Smaller firms are absorbing it not as well. Now, the question is, when are we going to see the pain of the smaller guys reflecting in the overall economy, which will lead to rate cuts and so on and so forth? The same is also happening in South Korea, where the ICT sector upturn and also companies like Samsung Electronics, there's anticipation that they're not only benefiting from the upturn of the cycle due to low inventories and higher demand, but also AI trends like being able to sell more memory chips to NVIDIA, for example, right? But the average Koreans are facing, particularly certain sectors, facing the fallout of higher interest rates, right? So we have these two factors colliding, and that's why you see a divergence in performance, even if the headline number remains quite resilient. We think that over time, you're going to see more cracks in the market. And so as a result, there's still some room for this to run, but we certainly will see a softening of the global economy in the second half, given the fact that the U.S., we expect deceleration of the factors I mentioned to percolate much more. And in Europe, political risks are rising, and so is the U.S. as well. And as a result, this uncertainty means that while you can still have some upside to equities, I do think that there's also higher risk in the second half as you start to see, and the question we ask here is whether or not we're going to have the soft landing that we want, which is what the Goldilocks scenario is like, that towards the end of the second half, we are going to both have rate cuts, but also still have resilient enough global growth to allow us to have a bullish earnings outlook. Now, I think that that's the baseline scenario, and the risk to not having that is quite high.
And that leads us to our next question, Professor Kim. Despite the stock market's seemingly upward trajectory, risks remain, as Trin pointed out, and one of them is, of course, the U.S. presidential election. But what other events or variables could increase market volatility throughout the second half of this year? And what preparatory measures should South Korea consider?
Every country is saying that the largest risk of this year would be U.S. Presidential election, which is an uncontrollable shock to Korean economy. If President Biden is reelected, there won't be much changes or shocks from United States to Korea. But if Mr. Trump is elected, it could bring significant uncertainties and challenges to Korean economy, particularly in terms of the trading. Mr. Trump will try to reshuffle Korean-U.S. free trade agreement by raising tariffs on all imports from Korea. Also, this uncertainty from United States presidential election in November will limit Korean companies' investment, and it gives a negative impact on Korean economic recovery. So Korean government should prepare all different possible scenarios between Mr. Biden and Mr. Trump.
And before we let you go, Dr. Kim, the South Korean government also unveiled a new roadmap to boost the country's trade and economic diplomacy. It aims to build the world's most extensive network of free trade agreements by 2027, among other ambitious goals. What are your prospects for the new initiatives?
The ultimate goal of the K-finance package is to position Korean economy as a central hub in global trading network. As of now, South Korea is sixth largest trading country in the whole world. So K-finance is a combined policy package that includes expansion of FTA with new trading partners, strengthening existing free trade agreements, economic and financial reforms to support these trade initiatives. It also includes technological and digital integration and support for small and medium-sized companies. I think it is very important attempt to broaden Korea's economic territory in foreign countries because Korea is simply one of the most foreign-dependent economies. So expanding free trade agreements with trading partners are very important infrastructure for boosting trading.
Well, South Korea has signed FTA with nearly 60 countries, so the goal of establishing the world's biggest FTA network doesn't seem that far-fetched. We'll monitor developments closely and with optimism. Thank you, as always, Professor Kim, for sharing your insights with us today.
Thank you very much.
And many thanks to you as well, Trin, as always, for your excellent analysis.
Thank you very much.
And that brings us to the end of the show. Thank you for watching, and be sure to tune in same time tomorrow to join our conversation. Goodbye for now.